So remember here we had our $250,000 in profit from this business that we created. Well, of course we could put it into our own, but if we put it into someone else's, then we want to understand what our return profile is going to be. And so this is what I would consider the path of the investor. And so if the first category is the path of kind of like the venture-backed entrepreneur, the second path is the bootstrapped entrepreneur, the third path is the path of the retail or just traditional investor. You have some extra cash and you want to put it into something else. So for example, you guys have probably seen the show Shark Tank, where there's 5 sharks that are all wealthy people and entrepreneurs come to them and they invest in their companies. Now, what they give is money and help, and what they get back is some percentage of the upside, depending on how the deal is structured. And so those sharks tend to have less time, and so what they're compensated for is risk. And so when you become an investor, your chief form, the chief thing that you give is that you de-risk the founder and you incur some of that risk, you shoulder some of that risk, not in exchange for work or time, but in exchange for capital, which fundamentally means I took time somewhere else, I did work somewhere else, and I'm going to throw that into your business so that I can offset your personal risk. Now, the benefit of an investor is that you can diversify to a wide degree, meaning you can take 100 bets, you can take 1,000 bets.